This presentation is billed as a Wall Street interpretation of the solar PV industry. There is a good bit of that here. There are 2 slides in what will be about 15 or 20 here that explicitly address that, and I'll show that. Everything else is background. It's a deep industry analysis which is necessary to draw those conclusions. I start every one of these presentations with the same slide, and it's about a 15-year outlook for the solar PV industry. And it's the way I look at the industry from a very detailed analysis perspective. When we look at it from this perspective, you have to take a look at technologies and levelized cost of electricity, both crystalline silicon and thin films. This is over the course of the next 15 or so years. We have to look at grid costs of electricity, which is the primary competition. Sometimes people lose sight of that. We look at where convergence happens, this ambiguous concept of grid price convergence, which is inevitable. It's simply a question of when. Then we have to take a look at market dynamics based upon supply and demand, which has been the crux of this particular forum today. When we look at supply and when we look at demand, we look at a potential for oversupply. We look at a potential for explosive growth and undersupply several years after that in the future. And we always have to consider wildcard technologies. So when we look at the overall industry, this, in my opinion, these 3 sets of curves, levelized cost of electricity by technology, what that provides you with is the competitiveness of technologies, companies, and the overall industry. The second set of curves is grid price electricity. I use the United States as a reference because we have cheap electricity in the US. If you can meet grid prices in the US, chances are you've done it in most of the globe. That's your competition. And the third set of curves is supply and demand. That's the set of curves that largely drives the dynamic of the industry, both over the short term and over the long term. If you understand these 3 sets of curves, you largely understand the industry. What's removed from this and has to be added down the road is other competitive factors, meaning other renewable energy. And we'll see that down the road. So all that said, the first slide, the next one here, is the first translation slide to Wall Street. How does a bank think about an industry when you have this presented to you? Well, you look at an initial growth phase. And what we graph here are simply relative measures of financing activity. What do companies do to raise capital to build out their production, for example, and stock performance? We are approaching the end of that initial growth phase, in my opinion, where we have actually seen a drop in corporate finance activity that will probably drop further. And we've started to see a settling out in stock performance, to say the least. That kind of gives way to a shakeout scenario. If we have this oversupply dynamic that many here seem to be talking about, myself included, we end up with a shakeout of some sort in this industry. I think that begins sometime next year, and I'll talk about that in a good bit more detail. What does that mean? Corporate finance activity falls off dramatically. It picks up as we go through a shakeout, typically in M&A activity, mergers and acquisition, and then back to corporate finance. What happens to stocks? Good companies tend to percolate up and down through a shakeout. Less good companies sometimes go to zero. And that's what drives mergers and acquisitions. It's a consolidation in the industry. That's what a shakeout will drive. What happens subsequently? You reach this ambiguous concept of grid price parity, you get explosive demand. What happens with explosive demand at that point? A rationalized industry builds out to meet opportunity. That's enormous financing activities, and it typically is good for stocks over time if you pick the right companies. What happens subsequent to that? You have a relatively mature industry. The industry now is either cyclical growth or cyclical. Corporate finance activity falls off dramatically, and stocks tend to fluctuate. And that's based upon performance of individual companies. All that said, this is kind of how Wall Street looks at an industry. And this is not unique to the solar PV industry. This is many industries. So bear this in mind, because now what we're going to go through are 2 of those sets of curves. First, supply and demand, which is basically the dynamic of the industry. And then we'll look at levelized cost of electricity, which is the competitiveness of the industry. So supply and demand. If we get a shakeout, what's it going to look like and where's it going to start? If you look at the beginning of this graph, there are several things graphed here. Module ASPs, crystalline silicon, not thin films. Module cost basis, and company gross margin that happens to be selling that product. This is about where we are right now. If you project out over the course of the next year and a half, year, in my opinion, year and a half, we get the incipients of a shakeout. How does it begin? You get enough polysilicon produced to allow a whole bunch of unutilized capacity at the cell and module level to churn out modules, deliver them to the market, and develop a momentary oversupply. Inventories build, what happens? It needs to be cleared. How do you clear inventory? You drop prices. ASPs will come down more than people think. My best guess on timing is that it happens in the second half of 2009. With the reset in ASPs, you get a reset in margin structures. With a reset in margin structures, what oftentimes happens is stocks go down. Stocks go down, it gets more difficult to finance, balance sheets are challenged, a shakeout begins. This begins a shakeout. It doesn't mean that you have to have a persistent oversupply. You need a catalyst event, which is a momentary oversupply, short period of time to drop pricing. Once that happens, there was a whole series of events that happens in corporate finance at companies which causes issues. Those issues precipitate a shakeout. The shakeout precipitates consolidation, and the industry's off on a new track. My belief is that this happens iteratively over several years. When this happens iteratively over several years, you end up with price drops, maybe not quite as regular as this. This is to essentially illustrate an academic point. It may happen a bit more random than this, but overall what's important to note is that margin structures for companies that play here will likely decline. It's as simple as that. It's never good for stocks. Typically, it's never good for financing and balance sheets over time as well. So all that said, effects are going to matriculate up and down the value chain. It begins in the middle of the value chain, crystalline silicon modules, where there is no price support mechanism. It matriculates up the value chain and down with varying degrees of severity. We'll talk a bit about that when we go a little bit further in the presentation. So let's talk about supply to begin with. And I'm going to go through this relatively quickly because you've heard this ad infinitum today. You look at silicon. Silicon gates production. It gates sales over the course of the next few years, without a doubt. All that said, these are the metrics that I use to come up with what kind of production you're going to have and consequently sales. If you look at production and sales, and they're two very different things, over the course of the next few years, there will be enough silicon, in my opinion, and this is a conservative estimate, I believe, to produce about 4, 7, and 12 gigawatts of crystalline silicon module production in each of 2008, 9, and 10. That needs to be adjusted for FGI, finished goods inventory, for example, at the end of the year, which means that you have less that is sold. That less that is sold, the bottom line, is installations. That is what crystalline silicon will allow us to do based upon a conservative forecast over the course of the next few years. Now look at thin films. Thin film planned capacity is very aggressive. I don't believe it. I doubt many people here believe it. Production is less aggressive. It's a much more subjective analysis for the simple reason that you have to look bottoms up. You have to look at every company out there as best you can and make a judgment call on how effective they will be at building out capacity and actually producing product. It's also very important to note that of the three technologies here, cadmium telluride, amorphous silicon dual junction, because I think that will probably define the market over time, the tandem junction product, and copper, indium, gallium, selenium, only one is in production. It's cadmium telluride. The other two are not. So again, the subjectivity and the variance error associated with this can be significant. Regardless, estimates are roughly 1 gigawatt, 2 gigawatts, and 4 gigawatts of production over the course of the next 3 years. Sales, adjusted for FGI, for example, as indicated. What does that mean overall? Total module supply over the course of the next few years. This is the end of supply in a sense. 4.6, 8.9, and 15.8 gigawatts of production, adjusted for FGI. 7.7 and 13.6 gigawatts in 2009 and 2010. That said, it's important to do some scenario analyses and put this in perspective. When you look at growth rates on the industry, and you put in our base case scenario, those are the numbers that I just mentioned and showed, you do a sensitivity analysis around that for an upside and a downside scenario. That upside case and that downside case, I won't go through all the assumptions, provide us with two other scenarios. And let's use 2010 as an operative year, 11.6 gigawatts and 16.3 gigawatts for an upside scenario. That brackets our 13.6 gigawatt number. That's sales. That's installations. Now the question is whether or not demand can match this.